Welcome to the program. My name is Marty Shankman, and I thank all of you for joining us. We have a really interesting, hopefully, program with lots of great ideas jam-packed into a brief hour of time. And what we're going to try to do in this brief hour is give you a little bit of an appetizing menu from the upcoming 47th Notre Dame Tax and Estate Planning Institute. And to tell you about the Institute, I'm going to turn it over to the director of the Institute, Jerry Hesch. Jerry, you want to give just a quick minute or two about the Institute, and at the end we have how people can sign on, but you should also tell them now as well. Sign up, yeah. I'm sorry.
Well, first of all, the Institute, we decided last May not to take any chances, and it's going to be 100% virtual again. Normally, it's the Thursday and Friday before a home Notre Dame football game. It still is going to be the Thursday and Friday before a home football game, but it's going to be virtual. And the nice thing about our conference is we have concurrent sessions. So there's about 28 different sessions over a 2-day period. And of course, you can't listen to all the sessions. You only can listen to 8 sessions a day, or 16 in total. And what we do is make the recordings for all 28 sessions available for 6 months after the Institute. So, and I know it's difficult to sit in front of your computer for 8 straight hours and listen to 8 sessions in your office. So you don't have to listen to every session during the day. We are going to make the recordings for every single session, all 28 sessions available. Your registration fee will include access to all of the recordings. The other thing which is interesting is having, been, I remember when I joined the University of Miami faculty and Phil Heckerling had me attend the Institute. Over the years, I saw that a lot of the programs focused on the current developments and focused on a lot of sophisticated planning techniques. And one of the things that I take pride in is at the Notre Dame Institute, we have a selection of very practical planning, very practical topics that you will run into in your everyday practice. In other words, you don't have to have a multi-millionaire client to get some benefits out of the Institute. The other thing is that we like to focus on income tax planning as well. And most estate planning institutes talk about step up in basis at death. And that's very important. But some of the pure income tax topics that we have, such as assignment of income to taxpayers in lower marginal income tax brackets and income tax deferral, are also part of the program, because you always have clients who aren't going to be able to wait to step up in basis at death and wanted to do income tax planning while they're alive. So we have a nice selection, and the focus of today's program is to give you an insight as to a selection of the topics that you should find of interest. And with that, why don't I turn it over to one of our sponsors here.
So wait, before we do that, just real quick, you can just Google search Notre Dame Tax and Estate Planning Institute. It'll come right up to register. Some other quick pointers. There's not much content in the PowerPoint, so forgive me, but we're going to have a very quick run through of a lot of different topics, just focusing on some interesting planning ideas to whet your appetite for the Institute. We don't give CLE or CPE program, but you will get a certificate emailed to you. If you have any questions, the best thing to do is email Jerry Hesch, care of Notre Dame. Our sponsor for today's program, first sponsor, is Interactive Legal. Jonathan, you wanted to say a quick word about Interactive?
Yeah, interactive legal is a system that I've worked on for about 25 years. It provides forms for your use. We have a tremendous number of them, over 100 forms, from very simple wills to very sophisticated types of trusts, including something you may not have heard of called a special power of appointment trust, or SPAT, which is something that you really need to know about, especially for this year, as your clients want to use their exemptions but want to be able to benefit from the property at a later time in their lives. In addition, we use artificial intelligence to guide you in certain areas, and we provide tremendous help and support. And I hope if you have an interest in it, you will call Vanessa Kanega, whose face is on the screen there, at the number that's listed there, or go to the interactive website. Thank you, Marty.
So let's one thing about interactive legal. The ability to pick up the telephone or email somebody with questions that you're unsure about, and they get back to you instantaneously. Interactive legal is the one drafting program in the country that gives you the access to an actual person that will discuss something with you. And that's one of the things that sets it apart. Thank you.
So it's been my custom on webinars wherever possible to feature a specific charity, different charity each time, just so practitioners gain some insight into some of the wonderful good causes and good charities that they may recommend to their clients. And for this program, we're going to have a word from the American Cancer Society.
Thank you very much for the opportunity for me to share a little bit about the American Cancer Society, and thank you to everyone who's logged into the program to learn how to better serve their clients in these meaningful decisions that they're making. The mission of the American Cancer Society is to save lives, celebrate lives, and lead the fight for a world without cancer. And there's a next slide. Is there one more?
Nope, that's it.
Oh, my apologies. Okay. As we all know, when cancer strikes, it hits from all sides. That's why we're committed to attacking cancer from every angle. With more than 100 years of experience in leadership, we are a global force fighting all cancers on all fronts across the U.S. and around the globe. This year alone, more than 600,000 Americans will die of cancer. That's more than 1,600 people per day in the United States. That's why, with our 1.5 million supporters, we are taking action. While most know us for our research, we do so much more. We promote healthy lifestyles to help you prevent cancer. We research cancer and its causes to find more answers and better treatments, and we fight for life-saving policy changes. We provide everything from emotional support to the latest cancer information for those who have been touched by cancer, and we do it all 24 hours a day and 7 days a week. Thank you.
And for those on the call, NPAN, the National Professional Advisor Network, if you're not a member, I encourage you to join. It's a wonderful way to show your support for a really outstanding organization and a vital cause. Thank you. So Jerry, you've given us a little background on the Institute. Do you want to make any planning comments to lead into the discussions, or should we just jump into the discussions?
Well, let's just jump in so people can get an idea of some of the nice topics we have.
Okay, so one of the topics to be covered at this year's upcoming Institute, and just to give you a little appetizing taste of it, is avoiding ethical issues. Alan and Jonathan, I'll turn it over to you.
Alan, go ahead. Alan, you're muted.
Sorry. Thank you very much. You'll attend a lot of presentations about ethics and avoiding litigation. But Jonathan and I have some unique strategies and some unique mechanisms that can be used to facilitate this. One thing that we're going to do is we're going to talk about what the red flags are that would show you as a planner what the possible problems would be. For example, is their family malfunctional? Is there a particular member of the family that would be of concern? Is this a situation where children may take advantage of parents, or where one child in particular may have an issue? And then we're going to talk about what to do about the possible issue. For example, if you could have children and grandchildren who are adults sign enforceable agreements to share an inheritance, notwithstanding what one of them may talk the parent into doing. Or you could have an agreement among siblings where a sibling who loans money to the parents will get that money back if the parents are not wise enough to spend money on things that they need. Or if you have a caretaker living with the clients, you can have the caretakers sign an agreement which legally binds them not to accept gifts or not to accept inheritances. So you can check with your state law with respect to this. In addition, when you talk to a married couple and you say, hey, do you realize when one of you dies, half of the assets or more will be completely owned by the surviving spouse, who may then leave it to the next spouse? Those clients will typically say, no, 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 that's not what we thought we were getting. That's not what was intended. Well, how about if there's a binding agreement between the spouses that the surviving spouse has to fund an asset protection trust for the primary benefit of the surviving spouse and for the benefit of the common descendants? So when you look at these types of situations, you come up with these types of solutions, and they can be very helpful and also provide a lawyer with very worthwhile projects. So Jonathan, what would you like to add to that?
Well, let me add that one of the most devastating things that people will go through is some sort of will contest after death. It will ruin the relationship of everybody in the family. And there is a way to prevent that. You can put in interorum clauses, but of course, Alan, where you are in Florida, they're not enforceable at all. And even in places like New York and California, they're enforceable unless you can prove that there was no reasonable basis for the suit. But one of the things you might consider is having a will admitted to probate before the testator dies. That's probably the best witness about whether or not it's a matter of free will. So as a consequence, I would suggest that you take a look at that possibility. The state next door, Ohio, has premortem probate. North Dakota has premortem probate. Alaska has premortem probate, and Alaska has something different, which is that you don't have to be an Alaska resident to have your will admitted to probate. And I've known a number of practitioners from outside of Alaska who've had their client's will admitted to original probate in New York before they die. So we can discuss that as well, Alan.
Actually, premortem probate, we had someone speak at it last year for an entire hour because it was something that a lot of people did not know was available. So these are the kind of topics we like to have at Notre Dame that you don't see on other programs. Go ahead.
So before we go on to the next topic, let me ask Alan and Jonathan a quick question apropos to the environment we're in now, where it seems like every couple of days there's new theories on what might happen in Washington. Can you each just give a tip or suggestion for practitioners operating in the current uncertain environment, what they might do to protect themselves?
Jonathan,
well, Marty, I think what you've got to do is to let your client know where things stand and what that client might be able to do. The client probably will do nothing because we don't know what will happen, although I think probably one of the smartest things, if you're like Jerry and you're rich and you can afford it, is to use your lifetime exemption well before the end of this year. There's no proposal to take it away before the end of this year. The really scary part, and I just don't know what to do about it, is the proposal to take away the tax-free step-up in basis, which Jerry talked about a few minutes ago, and the possibility of gains tax at death. That's one of the things that some senators and President Biden have proposed. And in fact, one of the senators, Chris Von Hollen from Maryland, has suggested it should be retroactive to the beginning of this year, which really puts you in an awkward position. Because, for example, if you want to use your exemption, well, are you going to fund it with appreciated assets? Typically, people would do that, but you might have a gain recognition event. And you can back it up to some degree with disclaimers properly set up, but the income tax effects may not follow the traditional disclaimer rules under Section 2518 for estate and gift tax purposes. And we'll discuss some of that at our
Next.
presentation as well.
Yeah, we're going to get into that next. Alan, any ethics tips just for the current environment? Maybe just a quick one.
I don't have any ethics tips for law changes other than to get your documents signed before the effective date of a House Ways and Means Committee release, which means get going. If you've got estate plans in process and the client hasn't signed that defective grantor trust or that installment sale document, get them signed because it may be too late otherwise.
More
All right,
important,
let's go on to our next.
more importantly, get them drafted and ready for signature at the last minute.
So let's go on to the next topic. So Jonathan and I are going to give an hour-long presentation at Notre Dame on creative planning of possible tax changes. And that presentation very likely will be written the day before, depending on when the law changes are. So it'll be current as of the date that we speak. And the environment is so volatile and dynamic that you know, what we would estimate right now may be coming down the pike may in fact be different. So whatever we do, we'll update to the very last minute. And Sandy, you're actually speaking on that panel as well with us. One of the things that I think to add to some of the points that Jonathan made, I think we need to do triage with clients and get them focused on what the most important things are that they need to do quickly. So for example, we all have new clients coming in that are new to our practices because they're kind of coming out of the woodwork trying to plan before a potential law change. And the closer we get to actual change, the more clients and prospects come in. Typically, I think it's probably common for all of us that if a client comes in and wants planning, what we first try to do is review their existing planning and see where they are and what needs to be done before we build new planning. In other words, to get the scope of what's in place first. And frankly, in the current environment, that's important because you want to make sure how much exemption has been used. If there are inefficient trusts that have not had GST allocated to them, it may be worth making a late allocation of GST exemption, especially if the client doesn't have the wherewithal to use all of their GST exemption and so on. However, in the current environment, and I think we need to document and caution to clients it is really not enough time to do that and do current planning. So we may want to almost sort of skip the review and the correction process for existing documents and focus on what they need to be done. I don't remember if it was Jerry Allen or Jonathan, but somebody said get trust drafted now. So if a client wants to use any of their remaining exemption, we really need to get focused on that. Another consideration is we may not be certain how much exemption's been used until we can review for a new client what's been done in the past. You may want to use a formula allocation that is marked to the or pegged to what exemption they have left. That same language could be used and was suggested in earlier presentations by various people when we were talking about the potential for a retroactive reduction in the exemption, but that same language may serve to adjust a transfer to no more than the client's remaining exemption in case there was errors or lack of information for a new client. Jonathan, and even Sandy, do you want to comment at all on some planning in the current environment? So before we go on to the next topic.
Yeah, so other things that we're going to be discussing in our presentation are the things that we can do as estate planners in what is a very scary planning environment. Because we are planning for clients under a cloud of uncertainty, making sure that the client, as Jonathan alluded to earlier, understands that there are risks involved with any planning that we may engage in. And in fact, planning we may undertake today may result in unintended consequences if there are changes in the law, such as when we plan for assets to be held in trust for a long period of time. Some of the proposals now pending could result in triggering events such as a distribution from the trust or an LLC, resulting in a deemed capital gains tax event. And so there's a lot of moving pieces, and making sure we explain the risks to our clients in an uncertain environment is really important to the practice at the present time.
And just to add that if we have any clarity on what the law might be by the time of the Institute, we're going to offer some specific drafting suggestions to deal with the issue that Sandy just raised. Jonathan, you want to make a quick comment and then we'll go on to the next topic?
He's gone.
Oh, that's it? Okay. Jerry, would I want to freeze a QTIP or non-GST trust?
It's interesting. Everybody does, you know, their QTIP trust, and the problem with the QTIP trust is for when the surviving spouse succeeds to the QTIP trust, the assets, if they appreciate in value between the formation of the QTIP trust and the death of the surviving spouse, all that appreciation is exposed to estate tax under the Section 2044. In addition, there are trusts that are exposed to the generation skipping transfer tax. And those trusts, you know, they're not going to be subject to estate and gift taxes anymore. But when the non-skip person dies and it becomes a taxable termination, all that appreciation in value will be exposed to the GST tax. So all we're doing is taking typical estate planning freeze techniques, and Ed Morrill in Cincinnati is going to be talking about this, how to use existing freeze techniques for where you don't normally think of a freeze, such as a QTIP trust or a trust that will be exposed to the GST taxes in the future. For example, you got a charitable lead trust for the benefit of the children, and maybe you want to freeze the assets in that charitable lead trust so that when the children succeed to it, they get a frozen interest. And that also, all we're going to do is take some very practical estate planning freeze techniques and show you how they can apply to QTIP trusts, charitable lead trusts, and trusts exposed to the GST tax in the future. And it's something that comes up all the time, and we like to sensitize the audience. This is another planning opportunity for estate planning that's already been put in place. That's it.
And just to highlight, this is really a valuable idea that is often off radar. In the current environment, many people that are well below the 10.7, clients that may have 5 million or smaller estates may think, gee, I don't need to do any planning. But you know what? If they have GST exemption, for example, that's not been used, finding a way to address the planning issues Jerry just mentioned could be very opportune for even smaller estates in the current environment. Sandy, divorce is sadly very common. What are you going to talk about in the presentation? I think you're doing it with
Sharon Klein.
Sharon Klein, right. What are you guys going to talk about at that program, and what tips can you give people on this really vital topic that affects so many clients?
Well, you know, as planners, many people don't really understand the implications of language contained within a trust in the context of divorce. And some planners believe, well, if I have a HEMS standard, an ascertainable standard in my trust, I've protected the asset in the event of divorce. That's not necessarily true. Different states have different rules. A pot trust may provide greater protection than a separate trust for an individual. The rights and powers that you give to a trustee and whether the beneficiary is acting as a sole trustee or a co-trustee can have an impact in various jurisdictions on whether the assets of that trust will be included in the marital estate or considered in the division of the marital estate. So we're going to talk about the benefits of premarital and premarital agreements, marital agreements, DAPTs, domestic asset protection trusts, and as Alan Gassman always reminds me, foreign asset protection trusts. We're going to talk about drafting considerations and some of the current case law that's occurred that planners may not be aware of in terms of how a divorce court may interpret the planning techniques that have historically been utilized when we create trusts for beneficiaries. We're also going to talk about how important it is in the current environment to carefully outline intent, as well as the definition of who will be considered a spouse, because there are some recent cases that there is at least one recent case that has held a prior spouse was actually a continuing beneficiary or interested party under the trust, despite the individual having remarried and having a new spouse to whom they would want to inure benefits from the exercise of a power of appointment or limited power of appointment provided within an instrument. So there's a lot of moving parts when it comes to divorce, and how important it is for divorce practitioners to pair up with an estate planner and an estate planner to pair up with a family law practitioner so they can really think about and address issues they might not otherwise be aware of during the drafting process.
Thank you, Sandy. Sounds great and certainly very important. So Jerry, maybe you should just tell people you're kind of plugging in here for some of the other speakers because we could only get so many people on the webinar. You're not actually going to be speaking on 6 different topics at the Institute. So I just wanted people to know that. But you certainly have some good topics that we'll be covering. What about existing income tax planning techniques? Any comments on that topic?
This is interesting. There's a lot, a lot of times we focus on step up and basis at death, giving like an elderly parent a general power of appointment to get some basis step up like that. But there's a lot of people out there who, for one reason or another, aren't willing to wait to step up and basis at death. And they have opportunities to sell appreciated assets where they're alive and realize the gain. And it's interesting, and this will become unbelievably more important if carryover basis at death is enacted. But you have situations where there are various planning techniques that allow you to have using related parties, such as a non-grantor trust for the benefit of your descendants, or charitable remainder trusts, or charitable gift annuities that can defer the reporting of a realized gain. And Austin Bramwell and his partner are going to talk about how you can actually use existing structures to defer the gain that is realized while you're alive. Now, this might become very important because we mentioned that what happens if death becomes a realization event of one of the proposals? Well, if you want to basically say, I want to cover, so in case death becomes a realization event, what can I do now? Well, why don't you engage in one of these income tax deferral techniques where you realize the gain, but you can defer the reporting of the gain to the future. So once you have realized the gain, and this legislation goes through that death is an income tax realization event, you've already realized the gain. And one of the simple solutions is you create a non-grantor trust for the benefit of your descendants, and you sell an appreciated asset to the non-grantor trust for an installment note. And you use the installment method to defer the reporting of the realized gain. So what happens in that situation you do like a 20-year interest-only note. The gain is realized, and as the seller, you don't report the gain until 20 years from now in the future when the principal is paid. Well, it turns out the Internal Revenue Code has a safe harbor that says this will work and the original sale can continue to defer the gain if the related party purchaser waits 2 years and 1 day to resell the appreciated property. For example, I have a $10 million asset with $1 million basis. It's eligible for the installment method. I sell it to the related party non-grantor trust for a 10 million note. 20 years in the future, I realize a 9 million gain. The purchasing trust gets a 10 million basis. And if the purchasing trust 2 years and 1 day later sells the asset it just purchased for 10 for 11 million, it only reports a million gain, and the other 9 million gain on the first sale can continue to be deferred. And by the way, it's also an estate freeze because you've frozen it at the current value of the note. So it can also accomplish the estate planning. So what they're going to do is go into the details of how the installment sale works, how the other deferral transactions work, and all these income tax deferral transactions, if you do them the way they're laid out in the statutory rules and regulations, in the code and regulations, it will work. And the nice thing about it is, if I want to defer the gain, I don't want to take any discounts because I want to maximize the gain deferral. So all they're going to do is, these are techniques that are there, they're available, and none of the proposals will change any of these techniques. So that's all. That's going to give you a flavor of what this topic is going to involve.
It was a very clever point, just even with the installment sale. And I think a lot of us in the estate planning space have not put enough attention and thought to income tax planning. But depending on the changes that are enacted, that will be an ever more critical part of practice. And as you said earlier, not just for basis step up, but the whole wide range of income tax planning. I'm going to ask everybody that's on the call to please mute their lines if when you're not speaking, to eliminate the background noise. Todd is on, and I'm going to ask Todd to jump in, and we're going to go out of order. Todd, why don't you give us 5 minutes of some creative thoughts on preferred partnership freezes?
Well, thanks, Marty, for having me. Sorry, I'm not on the video. I'm actually in the car coming back from a Maine vacation with my family. Say hi, guys. We're just making our way back from one of the islands off of Portland.
And Todd, I'm sorry to interrupt,
yeah.
but I do believe this makes your entire vacation now tax deductible. Continue.
Good advice, as always. So just a little preview for what we're going to talk about at the Notre Dame conference. Steve Brightstone, Jerry, I think is going to be joining, my colleague Joe Medina, and myself. We're going to be talking about different uses of preferred partnerships in connection with various different freeze structures. And when we say preferred partnerships, we mean partnerships that are compliant with Section 2701 of the code. As we all know, some of the more typical freeze structures, the GRAT and the sales to the grantor trusts, are being targeted under the Sanders proposals, and they have been in the past. Those proposals don't really talk about some of these other applications with preferred partnerships. And so for a number of reasons, I do think that we are going to see these vehicles get more popular as we go forward. However, unlike the GRAT and the sales of the grantor trust, which are, they have their complexities, as Jerry was just talking about, they are more straightforward. These preferred partnerships have a lot more moving pieces. They are statutory vehicles, but there are a lot of pieces from, of course, a 2701 deemed gift tax standpoint, a traditional gift tax standpoint, non-2701, as well as potentially partnership tax issues and adequacy of the coupon issues. So there are a number of things that we're going to have to go through in our presentation to really put meat on the bones. But generally, you know, these structures, similar to the GRAT and to the sales of the grantor trust, it basically involves an exchange of interest. In this case, you know, senior family member is taking back a more secure cash flow priority interest. And what are they giving up? They're giving up the upside potential to the growth in the partnership, which would be in the hands of the common interest holders. That would generally be a junior family member or maybe a trust for the benefit of junior family members, ideally maybe a GST exempt trust. And so there are a number of different ways that you can apply the preferred partnership, but it's basically, you know, ways to sort of provide for one more cash flow secure interest that's not going to grow. So maybe that would be in parents' hands, or maybe a GST non-exempt trust or some other less efficient vehicle. And you're going to shift over the growth into the more long-term common growth types of interest. And so we're going to explore all that. In addition to that, Steve Brightstone and Jerry are really going to be focusing on a lot of the income tax sort of planning opportunities with preferred partnerships as well. For instance, the ability to continue to preserve the ability to have the stepped-up basis in the preferred interest, assuming, of course, that the stepped-up basis doesn't go away under either the Green Book proposal or Van Hollen proposal, and also as a way to address the liabilities and excessive basis issues. So there are a lot of moving pieces. We're going to go through all that during the presentation at the conference, but that's really sort of the preview. So Marty, let me hand it back to you. And I don't know, Jerry, if you wanted to jump in for a second.
Actually,
Thank you. Go on, Jerry.
one of the things that Todd and Steve and Joe are going to focus on is phantom gain. When you have encumbered real estate where the liabilities exceed the adjusted income tax basis in the property, which is very, very common because a lot of people keep refinancing their real estate or do 1031 exchanges, which just kicks the phantom gain down the road, and show how, with no estate tax costs, you can actually eliminate the phantom gain if you hold the encumbered real estate to when you die. And it's something that is an income tax planning technique using the estate planning preferred partnership freeze. That's it.
So let's thank you, Todd, and thanks for the dedication calling in from vacation. So the next topic, I'll just take a couple minutes and comment about diversity. So we have a diversity panel that's quite large. I think we have 5, maybe 6 people on it. And it's under the auspices of Trust and Estates magazine. And we have some excellent resources that are a compilation of articles on different aspects of diversity from maybe the last year or so of Trust and Estates magazine. So it should be very interesting. And we're going to have a number of different perspectives. One of the things that we're going to try to do with the program is talk about diversity in practice. In other words, it's going to be a more technical, practice-oriented program, not an administrative or theoretical program. So one of the topics that we're going to talk about is planning for LGBTQ clients. And some of the issues, for example, that come up are how does one define a beneficiary? What if a heir beneficiary has a name or gender change? And third, what types of expenses can be covered by a trustee? And these are issues that there are traditional drafting techniques for. So, you know, a simple answer to all this is, okay, just revise the document, revise the trust, decant the trust. These may be administrative provisions, but they may not be, because it may entail adding a beneficiary. And simply revising a will may not suffice, because as we all know, clients don't often come back and revise documents every time there's a change. Could you provide a trustee with the authority to merely add to the class of beneficiaries so that if there's a child who should be added as a beneficiary, that they could be added even if not biologically related or adopted by the client. And the answer is that that can work, but it's problematic. And I did an article last year with a couple of colleagues trying to present a different perspective on this. And just one last point before I give you the concept or the idea. Many trusts provide for medical expenses being defined as provided under the income tax laws, permissible medical expenses. And even if the trust isn't specific as to that, that may be how a trustee interprets it. Well, if that's the case, the problem is that based on federal income tax law definitions, costly and important cosmetic and gender reassignment surgery for an heir going through transition may not be covered. So we need to address all of these issues in terms of defining heirs that are to be included, covered medical expenses, change in gender, et cetera, et cetera. So here's an alternative approach. And the alternative approach suggests creating a combination of a, let's call it trust protector or limited director for a trust protector that also holds a limited or special power of appointment. And this person should act under the instrument in a non-fiduciary capacity. It's critical because if the person acting in this capacity as the special trust protector is going to add somebody as a beneficiary, they really can't have a fiduciary obligation to the remaining beneficiaries. So if we appoint somebody in that capacity, we can empower them to add to the class of beneficiaries, so that if a child, an heir of the client, has a child, a person that they treat like a child, but is not biologically their child, and because of a range of different complications cannot adopt or does not choose to adopt that child, but in every other way treats them as a child, this special trust protector can add them back as a beneficiary. The special trust protector can provide clarity, because medical technology will obviously change, to medical expenses that should be covered. So that's a practical idea, and we'll give some drafting suggestions and sample language in the materials for how you can address LGBTQ planning. And what we're going to do in the program at the Institute is talk about a wide range of diversity issues from a practical, technical, drafting and planning perspective. We're going to talk about religious issues and much, much more. Let's go on to our next topic. Chris, are you there?
I'm here, Marty.
So everybody talks about SLATs. What can you tell us about SLATs?
Well, SLATs are a really popular technique these days because, as Jonathan mentioned earlier, a lot of wealthy clients want to use their exemption, but want to still benefit from it after they give it away. And using a SLAT is one of those vehicles that can accomplish both objectives. Now, a SLAT, by definition, is a trust established by one spouse for another spouse that the other spouse can benefit during lifetime. Now, that's a pretty simplistic viewpoint of a SLAT. And in our presentation that Brandon Ketron, my partner Brandon Ketron, and I will be discussing, we're going to get into the nooks and crannies and nuances here when it comes to designing and implementing these SLAT trusts, specifically as it relates to flexibility by use of trust protectors, by use of language that allows trustees a lot of discretion when it comes to distributions without causing any adverse estate tax or creditor protection implications. Likewise, we're going to explore the idea of what happens if the spouse is divorced. You know, you meet with a married couple and they can tell you, well, we're never going to be divorced. We've been married for 45 years. But as an estate tax planner and as an estate planner, you want to be sure that you know the clients what happens if a bad event like a divorce occurs. So we'll get into that. We'll get into something that Alan and I have been wrestling with called the Section 682 issue as a result of the repeal of Section 682 of the Internal Revenue Code. A former spouse, if a former spouse is a beneficiary of a SLAT after a divorce, then you can have adverse income tax consequences to the grantor spouse and it creates a Gordian knot that we really haven't come up with a solution to, but there may be some, and we can get into that in our presentation.
Hey, Chris, do you want to just give us a clue as to maybe one or two of the comments, approaches on dealing with the divorce issue?
Absolutely. So one idea would be to have an adverse party be required to approve any distribution to a beneficiary spouse. An adverse party is someone who has an interest in the trust that might be adverse to the spouse. Another idea is elimination of the beneficiary spouse as a beneficiary if and when there's a divorce. It can be a wholesale elimination as to the entire trust, or divide the trust at the time of divorce into a 50% each subtrust and eliminate the spouse as to one of the subtrusts.
That's a clever idea that I don't see too many people do. So sounds like good stuff. And I think the key take-home point is everybody and their kid brother is doing SLATs, but there's an awful lot of creative planning and drafting that Chris and his partner are going to enlighten us about. Thank you, Chris.
Thank you.
Alan Gassman. This reminds me of the old Brill Cream commercial. A little DAP will do you. What do you know about DAPs?
I encourage individuals to use DAPTs for a variety of reasons beyond external creditors. One of your largest creditor may be your soon-to-be ex-spouse. So using a DAPT as a planning device before you get married, as long as you disclose it in a prenuptial agreement, may be a belt and suspenders approach to protecting premarital assets, as well as an enhanced way to protect assets that might be inherited or gifted during a marriage. With the consent of the spouse, you may be able, while still in love, to have them waive the right or agree to you being able to formulate a DAPT to protect those inherited assets or gifted assets if they were gifted outright or they've got rights of withdrawal, and you're not going through a decanting process to protect them for against future claims. So there are a lot of reasons why a DAPT may be a viable estate planning document beyond normal creditor protection and can help in the marital property arena.
I would go a step further to emphasize the importance of what Sandy just said. DAP should be on the discussion board for everyone doing prenups. It's just a phenomenal tool to backstop a prenup, and certainly in that context makes sense. And I'm sorry, everybody, for the technical issue with Alan's audio. Another concept for DAPs is got nothing to do with asset protection, and that is that in the current environment where clients are struggling to use exemption and secure exemption, not every client is married. So Christopher's comments on SLATs were great, but what about clients that are single? Some clients that are single could still use a SLAT concept. They may have siblings or nephews or nieces or cousins that they may make non-reciprocal trusts with. But for a lot of clients that are single, and it's a very large percentage of the client base who are not married or not married in traditional family units where SLATs make sense or are viable, using a self-settled trust or one of the variations of it is just a phenomenal tool. Because for most clients that don't have extreme amounts of wealth, using 11.7 million of exemption, if they can't preserve sufficient access to that money, they're not going to comfortably make transfers. And by the way, for us as practitioners, we want to make sure that we've given clients options at least to pursue, even if they choose not to maintain access. None of us want a client coming back years from now complaining, gee, you convinced me to set up this trust. But if the trust is a self-settled domestic asset protection trust in one of the 19 jurisdictions that permit them, the client can make a transfer and yet remain a beneficiary. And variations of the DAPT include a special power of appointment trust, which typically will be done in a DAPT jurisdiction, but instead of the client being a beneficiary, somebody in a non-fiduciary capacity can appoint assets to the client. And another variation is what's sometimes called a hybrid DAPT, where you're not a beneficiary today, but somebody in a non-fiduciary capacity can appoint descendants of your grandparents. So there's a lot of creative applications of DAPTs. I apologize to Alan if we didn't, Sandy and I trying to help with the technical issues, didn't get his points, but it's a great topic and something that deserves a lot more attention. and I'm sure it'll be very worthwhile. We've covered preferred partnership freezes. So Jerry, we're getting near the end, but we got another topic from you, the impact of mortality tables on charitable trusts. Do you want to comment?
Yes, and this goes to the fact of that all charitable split interest trusts, charitable remainder trust, charitable lead trusts, if they're for life, use standard mortality tables that you're required to use under Code Section 7520. These mortality tables are 21 years old, and they're based on the 2000 census data. They're supposed to have been updated every 10 years, but the Center of Disease Control did not release the 2010 census data until 2020, and the IRS hasn't gotten around to updating the tables. So what we're going to show, what this topic is going to show, by Jason Havens, who's a charitable planning person at Holland and Knight, is how you can arbitrage the mortality tables in conjunction with interest rates and whether you use an annuity trust or a unit trust to actually increase the non-charitable benefits that you receive in a way that's permitted under the Internal Revenue Code. And it's all in the math of how the mortality tables and interest rates work. Let me give you one simple example. If you set up a charitable lead trust and you retain the right to all of the income for the rest of your life, which has to be an annuity or a unit trust interest, and for someone age 70, and you set up a charitable remainder trust for your life, what that means is upon your death, the charity is going to receive all that's left in the trust principal. Well, the standard mortality tables, which are based on the US population as a whole from the year 2000, say that the average life expectancy of an individual age 70 is 14 years. Now, what that means is that there's a 50% probability that individual age 70 will still be alive. In reality, so what happens is the value of your charitable deduction is the present value of the right to receive trust principal in 14 years. Well, in reality, someone age 70 could live to 90 or 95, not 14 years, but 20 or 25 years. So when you set up a charitable remainder trust, the charitable estate and gift tax deduction and the charitable income tax deduction that you get is overvalued, because in reality, it's not the charity's right to receive it in 14 years. It's the charity's right to receive it in 20 to 25 years. So what this topic is going to do is take all these concepts of the mortality tables and the discount rates and show you how they can be used to actually increase the gift and estate tax benefits and income tax benefits of charitable split interest trusts by just deciding how to take advantage of the distortions caused by the mortality tables and the interest rates. It's a topic that is technical, and the speaker is going to illustrate it with simple to follow numerical examples so that you can use these numerical examples to communicate the benefits of this to your clients.
But by the way, that's something, Jerry, I'll pay you a compliment that you've always excelled at, and it's something that many of us have struggled with. You know, the most phenomenal planning ideas, if we can't communicate the concept to the client, is very hard to help a client understand what they're doing. And I've seen Jerry speak, and I appreciate and laud him for the effort that's going to be made in this program to use simple examples, because that's really a wonderful practice tool to help educate clients on esoteric planning. And that's certainly something that's a hallmark of the Institute. Jerry, I think we're kind of out of time. I hope everybody has gotten a lot out of this. I've certainly heard some very creative ideas on just this little appetizer. Do you want to make any final comments about the Institute and that listeners might want to hear?
Well, the nice thing about it is you don't have to sit there for 8 hours a day for 2 days. All the sessions are being recorded and will be made available to you. I know that every time I listen to a program, something comes up during the day and I can't listen to. So it gives you the flexibility to pick and choose. So you don't have to listen to every session every day. You have the flexibility to log in after the fact and listen to it at your leisure. The other thing is for people who normally would not travel to South Bend, which is not easy to get to because there's very few direct flights to South Bend. For anybody, unless you're in Indianapolis where you can drive, right, Beverly? Okay. It's people who normally would not have attended a live program have the ability, and to be honest with you, 2 days or 2.5 days is about the maximum that anybody can really devote. I mean, some of these programs go for a whole week, and to be honest with you, it's a lot of time. And the key is not only the flexibility to listen to all the recordings for 6 to 9 months afterwards, but topics that you normally would not find on your typical CLE programs in estate planning.
I think that's one of the great strengths of the Institute, and Jerry deserves credit for that. He thinks out of the box and doesn't just merely repeat the programs being done at every other institute. And hopefully you all attending have seen that just from today. Some of the income tax and non-tax personal human aspects of planning, which Jerry has always been very sensitive to, have always been an incredibly valuable part of the Institute. And I can tell you that I've attended for many, many years, and I've taken copious notes at the Institute. I enjoy getting my 16 hours of credit, so it makes it easier when I have to get my CPE and CLE credits done. But I've always learned a lot of fascinating ideas, new ideas in areas that I was not familiar with, and I'm sure this year will be no exception. I want to thank.
But wait, Marty, one other comment.
Yeah.
Most CLE programs is 45 to 50 minutes. And every one of our sessions is 60 minutes, but we don't tell the speakers to add another 10 minutes of topics. We said, spend that extra 10 to 15 minutes giving the listeners the background, the principles that you're going to be applying so that if you're not that familiar with the topic, they give you a little bit of the background and lay a foundation so you're able to understand it a lot better. Okay.
So I want to thank everybody that spoke on today's panel. I want to especially thank Jerry for all his hard work for putting together the Notre Dame Institute. And I wish everybody a good day. Thank you for joining us.
Thank you.